Welcome to Opal TV. Today I'm in New York together with Jack Schwager. He's the famous author of the Market Wizards series. Jack has just published his fourth book, The Hedge Fund Market Wizard. And we're here to talk with him a bit about, first of all, how did you get started? How did you get the idea to write about market wizards and the top traders?
Well, the original idea I had was simply, I thought it was a good idea to go and interview all these traders because it actually seemed like a fun project to do. Not so much, I wasn't even thinking about writing a book so much, but I said, that's a good way to meet all these people and actually learn something myself.
Now, this is your fourth book. Tell us a bit about...
It's a fourth Market Wizard
The fourth Market Wizard book,
right,
yes.
Yeah.
Tell us, how do they all differ?
Very easy. They all have different people. And every person has a different personality, different story, different lessons, different way of trading. Even within this book, everybody I interviewed is completely different in how they make money in the markets. It's amazing. I mean, I couldn't even make up as many various ways of trading markets as these people are using. Even if I started out ahead and tried to make up 15 different ways of trading the markets, it wouldn't be as diverse as the people that I actually ended up interviewing. So how they're different within this book and across the books is there are different people, different ways of trading.
So it's 23 years now since your first book, and we're now in 2012. If you compare the two time frames, what has changed?
Well, of course, markets are always changing, but certain principles, but the main principles don't change. So the traders themselves, in terms of why they're successful, those tend to have common definitions. Now the markets, well, if you take back when I did the first Market Wizards book, which was 1988 or so, 1980 when I wrote it. Back then, a number of the traders I had were more macro futures type traders, and in those times, particularly in the 80s, and actually some of them started in the 70s, some of them even started in the late 60s, you had markets which trended more in bigger moves and smoother fashions than they do now. So strategies that may have, like someone like a Richard Dennis, who may have done phenomenal back in that type of environment, that type of approach, that turtle approach, which he taught, it lost a lot of its efficacy over the years, because when you have, as Michael Marcus, who I interviewed in my first book, says, when he's trading against the dentists of the world, then he has the edge. But once he's trading against other professional traders and other people who have programmed systems that are effective, you start going from hundreds of millions of dollars, billions of dollars, tens of billions, hundreds of billions, trading on the same type of strategies. They get in each other's way to some extent, and it's true of any strategy. So I think one big change is the big trend following profits that were easy to take in those earlier years no longer are. That you can still get big trends, but markets tend to have more false breakouts. You tend to have lots of choppier conditions. It's more difficult to make money doing that type of approach. You can still do it, but it has to be a bit more sophisticated. I think you do have people who do spectacularly well still, maybe not on the realm of some of the things, because I think the markets just had easier fruit to pick in those days, to speak. So if you, in those first books, you get somebody like a Michael Marcus who runs a $30,000 account into 80 million. That's a little bit hard to duplicate, but you still have traders today who have extremely good return to risk, which I think is the key element. So you take somebody like Bluecrest, Michael Platt. They're running now close to $30 billion. The flagship fund, he's run this fund with mid-teen returns for, I don't know, close to a dozen years, and he's never lost. They've never had a drawdown which even reached 5%. To me, that's incredible. That's really phenomenal skill. So yeah, you still have great traders today, and of course, some of the traders I interviewed were around were still trading at the same time I did my original Market Wizards. I didn't interview him at the time. So Ed Thorpe is the classic example. He, in fact, is one of the original traders. He goes all the way back into the 60s in terms of trading, and And he has, of all the traders I've ever interviewed, and in fact, of all the traders that have ever existed, with the possible exception of Simmons with Renaissance, and I'm not sure who has the better record, but he would, I think, have one of the two best records, if, Simmons being the other one, that has ever been compiled in trading in terms of return to risk. 90, he has about, I think it was the exact amount, I think it was something like, he traded for the first fund for 227 months, 230 months, and he lost 3 months. It was like a ratio, it was like almost 99% of the time, almost 99% of the months were winning months, and the 3 losing months, he lost less than 1%. And the return was near 20%. So that is just an incredible record. A lot of people don't realize that Ed Thorpe really was discoverer of the Black-Scholes formula for pricing options. And he actually was using the formula, or a mathematically equivalent form of the formula, about 4 years before it was ever published. But of course, he was using it and making so much money, he didn't want to publicize it. So he didn't win the Nobel Prize, but he actually did come up with the equivalent formula. Yeah, you still have you have people who are in this book who have phenomenal performance still. Yes, they're still out there.
Yes.
Although he just manages his own money now for the last 10 years, and he's not officially in the hedge fund management business, but still active.
So for you personally, what were some of the takeaways, the main lessons from your new book?
I put 40 of them at the end of the book, and it's kind of hard to say which are the most important ones. There is one there are a few that I say are always essential, and to take a couple that are in this book that were in the other books, but they're so important. So the one thing I always tell everybody, and anytime I give a talk on trading, I say, if you take nothing else out of this, I would have to say, the one thing you have to realize is you have to find the trading approach that fits your personality. So many people will write me emails, and I'll get a typical email, and they'll say, I loved your book and all of that. I want to be a trader. Could you recommend some traders I can work for? I'll work for nothing. I'll work hard. I just want to learn from one of these traders. And to me, that's the wrong approach. You have to. I hesitate to say you can't learn from. You can learn, but you still have to develop your own approach. Because if you go to work for some other trader, if you're naturally long term and he's a day trader, you can't learn that. So every person has their natural instincts, whether it's fundamental versus technical, or short term versus long term, more risk versus less risk, and you have to find your own approach. That's one essential thing. Another, I'm just picking here, I don't know, things I think are absolutely critical. Big one is flexibility. Traders that are really good can change their mind on a dime. And I think I use a line in the book, sort of quoting myself here, and it's that good traders liquidate when they're wrong, great traders reverse when they're wrong.
Let's talk about the one lesson that you formulated about volatility, right? Where you say volatility does not equal risk at all times. Tell me more about that.
That's a super important concept because it flies in the face of so much of what a lot of the academic community has developed and believes, a lot of the investment world operates on, and we've sort of developed over the years into a process where people believe that volatility and risk are synonymous, and it leads to so many investment mistakes because they're not the same. And so there's two sides of this coin. One side is that low risk does not imply low volatility, and the other side of the coin is that low volatility or high volatility doesn't imply high risk. But let's take one at a time. So the idea that low volatility equals low risk is kind of beguiling because people want to invest in a manager that gets nice, smooth, little returns, little ups, and very low downs, and surely that looks good. And if the process is one where you can expect that to continue and there isn't what I call hidden risks of a large decline in that process, then it's okay. But the problem is that so much of the hedge fund world operates in strategies that are really skewed to the left side. And they'll make money most of the time, but they are either explicitly or implicitly short volatility. So to keep the discussion in its most simple form, we can talk about someone who's short volatility. And the simplest example is a seller of out-of-the-money options, steep out-of-the-money options. So a strategy like that, if you look at it, you will see very, very nice smooth returns. Because why? If the market goes up or down a little bit, you collect premiums on both sides. If it even goes up or down moderately, you collect premium on both sides. So almost every month you're making money. The only time it goes wrong is when there's a sudden big move. And then not only do you lose, but do you lose asymptotically, because you start off with an option that loses a dime for every dollar, and then it goes to 20 cents for every dollar, 30 cents. So as you're losing money, your position is increasing exponentially. So you have a strategy which will make money a very large percentage of the time and looks good in that respect and has low volatility, right? But once in a while can get a giant loss. So there's an example. Selling out-of-the-money options is a great example of low volatility and very high risk. So, and in fact, the low volatility itself is sort of a signal, a hint that there's a potential risk there, because a lot of very low volatility strategies have low volatility because they are implicitly strategies that are selling insurance, and so they look good, but they don't take into, but if their track record doesn't include the occasional hurricane, then then you can be beguiled to think it's low risk. So that's the essential idea, is that a lot of times you get strategies that win most of the time, but you have to understand the process, and they can actually they can be taking on risks that can blow up. It's sort of like strategies where you're willing to walk through a minefield with their mines scattered about, and there aren't that many mines, but if you walk far enough and long enough, eventually you step on one of them. Before you step on a mine, it looks very good. It looks like it's low risk. It's a stroll in the field until you step on the mine, and that's what these strategies are. So that's my point. Is you see something that's low risk, that doesn't mean it's low volatility. That doesn't mean it's low risk. It means it might be, but not necessarily. You have to see where the profit's coming from, and is the process vulnerable to a large loss. Right. That's that side. And the other side of the coin is that you can have strategies that have very high volatility and yet are low risk. So somebody like I mentioned, Jamie May, who is always structuring his trades asymmetrically. So he'll, let's say, have option position where he's long. Take the simplest case where he's, let's say, the shipbuilders, for example. He'd be buying puts. So if they go down, he can make a large profit if he's right. And if they go up, he'll lose his premium. So, because he does these trades where he gets occasional large profits, he will have a very volatile record. But the volatility is all on the upside. So if you're looking at volatility, he's, very volatile trader. But the reality is he's structuring all his trades, so his loss is well defined. So again, so it's exactly opposite of the way people think. I could show you high volatility traders who are low risk, and I could show you low volatility traders who are high risk.
Jack, in your new book, you also featured Ray Dalio from Schwager. Now, I wonder, did you figure out how Ray and his team manage to deal with those absurd amounts of money, 120 billion plus probably, and still have this outstanding long-term track record?
Well, what he's doing is he's a big believer in diversification. Okay, so, and he's diversifying, I guess here, he's diversifying not in correlation terms. Everybody focuses on correlation. The problem with correlation, and correlation is good, it has its uses, but there are a lot of pitfalls with correlation, and one of them is that market correlations change over time. So you can have something like stocks and bonds, and certain economic phases they might be going in the same direction, and in some economic phases they go in opposite directions, and you can be getting those transitions. So if you're using the correlation of one market versus another to decide if they're diversified and looking back, that could be very misleading going forward. So that's not the way they do it. They are looking at the drivers for each market, for each spread position, for each strategy, and they're looking for markets that have different drivers. And so they believe the way they structure it, they do have truly uncorrelated trades. And they have like 15, 20 big core positions, and then they'll have another, 70, 80 smaller positions, but they're always trying to keep as much mix in the types of trades and types of drivers that they can do. So that's certainly critical. I mean, they couldn't do what they couldn't manage their money unless they had a very effective way of diversifying. So and they also trade just about every market, very, very diversified in the number of markets they trade. And they have done probably as much research into how markets behave going across all economies and going back hundreds of years. They've just developed systematic applications of that fundamental knowledge that is very effective.
So you're featuring traders and successful stock pickers and fund managers for over 20 years, right? And now in your latest book, what are some of the managers that you found are really the most diverse or most kind of off track?
Well, there's one that I would say is certainly the most different from not only every trader that I have ever traded in a book, but he's actually more different than any other trader I've ever interviewed, and that's a fellow by the name of Jimmy Baladimas. And actually, it makes my title of my book, Hedge Fund Market Wizards, a slight lie. Why? Because he's not a hedge fund manager, he's really a prop trader, but he's the only one. And I put him into the book because he was fascinating in that he was able to make money the way he does it. My first line of his chapter, I believe, was Jimmy Baladimas breaks all the rules. And he does. He does everything you're not supposed to do. He doesn't use stops. He sells wildly into big rallies. He just does everything that literally breaks all the rules. And yet, he seems to make money just year in, year out, and he's been one of the most successful prop traders for his company. And the amazing thing is, and my son Zachary kind of brought that to my attention, was that a lot of times he's wrong in the market. Wrong in the market, he's on the wrong side, and he still makes money.
So how
does he do that? Yeah, how do you do that? So here's the interesting thing, and this actually brings us to one of those 40, you asked about things that I learned in the book, and this is one that's not in the other books, and it answers the question of how can you be very profitable when you're wrong in the market, all right? So a big thing in his philosophy of trading is always trading around a position. So let's say he's short and the market's going up. And in the morning the market opens up down, he grabs all the money, market rallies in the afternoon, he'll sell some back. So he's grabbing all these trading profits even though he's wrong in the position. Of course, if he's right on the position, then he's right on the trend and he's right on the trading profits. But he's so good at trading around the positions that even when he's wrong, he's either breaking even or making money. I went to interview him, it was, I believe, April or so of 2000, I think it was 2011. But what I do remember is the market had been up like 3-4 months, very strong. And in fact, the month that it was that month, or it was the last day of the month I was interviewing, right at the end of the month, the market had gone up like almost every day. There were like very few days where the market went down, which was up, 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 up. And I knew that he was basically short the whole time. The day I went to interview him, the market had the first big break. It was down like 3-4%. His screens, he had all these screens in front of him. All the screens, a sea of red. So that day, actually, that one day, he sort of, even though the market had been up every day of the month, in that one day, he got back all his losses because he'd been making trading profits around every single day, even though he was wrong in the trend. And the other thing that was an interesting, which is important, that one of why he's successful, he does have this trait for sure, is the complete just lack of emotionality to the trade. So you'd think I'm coming in, imagine you or imagine me or most people you know, if you were kind of short a market, it's going up and then one day it's down really big and you got all your losses back for the month, you'd be buoyant, you'd be just, God, what a great day. You wouldn't have known anything was up. You couldn't tell. If I didn't know his position and didn't know what the market had done, I would have no idea anything had happened that day. And I can guarantee you, if it had been just the opposite, if he had been short, the market was up 3%, I wouldn't have been able to tell either. That sort of lack of emotionality, that very even keel to the markets is really important, is an aspect that really good traders have.
Now, this is obviously an example of a very active trader trading around position all the time and making his money there. On the other end of the spectrum, you have strategies like value investing, which you also have featured in the book.
Right.
Tell me today, is value investing still working?
Yes, and I say that through my association with the best trade I can pick to exemplify that would be Joel Greenblatt. And just for background, let me just say this, because Joel Greenblatt was originally an event-driven trader, and he wrote this book. We'll get to value trading in a minute, but this is kind of interesting. He wrote this book where, I forget the exact title now offhand, but it's something you can be a market genius or something like that. But it was actually an excellent book, and that book was sort of the Bible for a lot of the great event-driven hedge fund managers that will acknowledge Joel Greenblatt. And he ran a fund originally called the Gotham Fund, which he ran for 10 years. And this was one of the mysteries when I was researching him. The fund, I found the record, ran for 10 years. It had an average return of 50% a year. Its worst year was up 28%. Okay, so that was his worst year, and he had an average of 50%, 10 years, and it closed. So one of my first questions was, why did you close the fund? Well, he closed the fund because he had made so much money that he couldn't continue using his approach, which was then event-driven, with all that money. So he continued to trade his own money and partners' money, principals, and they gave back the investor money. So that's why the fund closed. But then eventually, over the years, he was always value-oriented. And then but he realized that you could manage much more money over value, it's just pure value, and that's what he's evolved to now. But he has a very interesting point about value investing. And actually, this is one of the let me take another tangent here, because I think he said they did this research, and they took they divided stocks into deciles, and based on their value, they built this little model, this little formula, and a simple formula, and they divided stocks in top decile to bottom decile based on a formula. And what they found was that the top 10 beat the next 10, the next 10 beat the next 10, all the way down to the bottom 10. So it was just perfect, a perfect fit to the value measure. So the better the value measure, the better the performance. And so I asked them, and I said, well, yeah, why then just buy value stocks? Why don't you just buy the best value and go short the worst value, and you'll be hedged and you'll have better return risk? Wouldn't that make sense? He said, that's a good question, but that's a question also that he teaches a course in Columbia graduate school. He said that all my students ask the same question too, and a number of different people. And the answer was that he told me that that's a good idea, except you would have gone broke doing it. Why? Because there were extreme points like in 2000, where 99, 2000, where value investing performed so badly that the worst decile on value were doing very well, and the best. So you would have lost more than 100% of your money, literally. If you count the 200% position, long and short, as your money, you'd have lost more than 100% doing it that way, even though you think you're perfectly hedged and you have a strategy that sounds statistically like it should make a lot of money. So the lesson there is that value investing can do very badly, and that brings me back to his key point. And I think I can summarize it, and I'm speaking here for Greenblatt, maybe philosophy in 3 steps. 1, value investing works. 2, it doesn't work all the time. And 3, because it doesn't work all the time is why it works. Because if it worked year in, year out, then so many people would start doing it that it wouldn't continue to work. But because it can have these periods like 99, 2000, where it just does so, early 2000, where it does extraordinarily bad for these periods, that knocks enough people away from the approach. So that's why it continues to work. I mean, it works not only because of that, it works because there's a good logic to the value investing approach. But it continues to work, and it isn't killed like trend following was killed, because it can go through such long periods where it doesn't work that not so many people follow it. So that's the lesson of the value investing. Yes, it absolutely works, but you have to be very long-term oriented. You have to be able to do enough work so you're fully confident in your positions, and you have to be willing to suffer pain for a year and a half, or maybe longer, and stay with the position as long as the fundamentals are still there.